Hey everybody, this is Jose Blasco. We are about to get started in a few seconds. Let's have a quick sound check, if that's okay, as always. A quick message on the chat box saying hello would tell me that you hear me, and then I know sound is good and we're ready to begin. All good on my end, just waiting to confirm on your end, and we start in 20 seconds, everyone. Thank you so much. Ten seconds to go. Thank you for that. This is cool. That's it. Time to get started, everybody. Thank you for joining me. Today is October 16, 2022. My name, Jose Blasco. This is a top trading session, the sessions where we go over top. I'll mention a few more details in a moment, but before we get started, I would like to highlight on the upper left our financial disclaimer. Please read it carefully. This is important information. As I always say, it's fairly short, and therefore I'm counting on you all to read it completely. Thank you so much. It's basically now highlighted, and therefore I understand everyone got time to read it. So again, the top sessions, in case you are new to the sessions, those are sessions where we go over the functionality in top on how to use our predictive options planner, the platform we call top. Obviously, many times when we are going over the use of the software, often we cannot go over functionalities unless we talk about trading, and therefore our top trading sessions often become a mix between trading lectures and platform time. And for sure, I'm more than happy as always to take your questions. Any of the questions are certainly welcome. So make sure you participate, you're engaged during the sessions, and that way we'll make them count. Thank you for that. So let's begin. Here we go. Here's our platform top. We've been conducting multiple sessions, many actually sessions, going over all the functionalities built in the platform top. Top it's quite advanced, isn't it? It's a professional grade options platform, and therefore we had to spend many sessions to go over all the functionalities. Some of you guys may end up using 1, 2, 5 functions, and that's what you do, and that's how you trade, and you don't need more than that. But because every trader is different, there are actually many functions inside the platform that are extremely powerful and that are available for you to use. The function that we're going to discuss today, it's the projection tool. Okay, we're going to talk about the project tool, which you could load by just clicking on the project button, like I just did, and this window shows up. Okay, but to be honest, you can call this projection tool from many other places. And today we're going to spend a little bit of time looking at this particular function, this particular feature, this particular tool, so you can understand it perfectly, since it is extremely powerful. Actually, it's one of the most powerful tools built in top. Mark, Jeff, everyone, it's good to have you with me, guys. Thank you so much for joining me. And by the way, I'd like to throw a little apology out there. Because we've made a couple of mistakes with the live sessions this week, isn't it? There have been a couple of errors with the scheduling, which is not a common thing, I would say. But yes, this week actually we made 2 mistakes in a row, and this may have driven you a bit crazy with our schedule. And if that's the case, again, I would like to apologize about that. I guess next week everything will be back to normal. Again, sorry for that. Anyway, so the projection tool. Okay, so first of all, let me show you from where you can call it. Okay, so you can come here to the main menu, right? Let me zoom in, and you have the button project, and of course, if you click on that button, then the projection tool will load. Okay, and here it is, and now you have it there ready to use. So obviously, this is one option, this is one possibility. Which is certainly quite common and very useful. But I would say that depending on the other tools that you use inside top, it may be more useful actually to call the projection tool from other places. For example, let's say you use the strategy builder and you right click on the chart, send to the strategy builder, and you are building your options trades this way, and then you sort based on return on investment. And let's say you want to do a bull put spread. Well, guess what? From here, you can right click, and not only you can get a risk graph or any other things, but you can also use the projection tool from here, right? So if you were to call the projection tool from here, the next thing you know, you have a projection tool built in here with the particular bull put spread on the top that was created using the strategy builder, which is another tool. Or maybe you didn't call the strategy builder from here. Maybe you like to build your options trades using an option chain, and maybe you do it manually. Maybe you have a series of rules. Maybe you wanted to use February expiration, and as you are using February expiration, you went to control click on a specific strike price, and then click on a specific strike price to build, let's say, a bull call spread here on the top, right? And now that you build that bull call spread manually using the option chain as we covered in prior sessions, now let's say you want to project this tool, so you can just right click on the bull call spread on the top, and you can also launch the options projection tool from here. So in other words, basically anywhere where you may have created an option strategy, you could right click and call the options projection tool and come to this window. Or, as discussed at the very beginning of the session today, you could just click on the project button on the left, the projection tool will load, and then here you can either, like in many other places in top, isn't it, you can just look for a bull call spread, an arrow on condor, whichever strategy, which is the one you're building, you can just call it here, okay? And it's going to be built for you, and then you can adjust it by editing the spread and adding more legs, or changing expiration dates, or doing anything you'd like to do anywhere else in the platform, okay? So in other words, from wherever you have a choice to build an option strategy in top, which is basically everywhere, could be on the chart by right-clicking and go to the strategy builder, could be on the option chain, could be on the spread select, could be on the risk graph, anywhere where you have a choice or an option to build an option strategy. Once you have the option strategy on the screen, you can always right click and click project, and you would come to this window, or one last time, click project, and then build your trade manually here on the top of the projection tool. So then you will be dealing with the projected values on the bottom part of the screen, which is going to be the next conversation to have, which will take the whole session for today. But before getting into what we see on the below part, I wanted to point and make sure everybody understand the fact that from anywhere you have an option strategy, you can right click and project it. Okay, cool. So I guess this is probably clear. Let me take a look at the chat box. Yes, Jeff. So what is the purpose of the projection tool? Very good question, Jeff. Thanks for that. So I'm going to get into this right now. Let me maximize the screen so we can now understand what is the projection tool going to do, how to use it, how can you take full advantage of it. Now, of course, before you use the projection tool, you need something to be projected. Could be a long call, a short put, could be a spread, could be a directional, a non-directional trade. It could be anything, could be a combination of stock and option. So anything that is tradable, it can be projected. Okay, so let me go ahead and do something a bit more sophisticated here, just for fun. So let's say you wanted to do a call ratio spread, for example. So you can just get a call ratio spread here, and in this particular spread, in this particular case, you would be buying the 358 call and selling 2 of the 359. So let's say you wanted to be a bit more directional. So instead of 359, maybe you went to 365, and when you click OK, so here is your trade. Okay, actually, it's still bearish with negative 35 delta. Let me push the strikes higher. Instead of 365, let's make it 375. Let's see, now becomes bullish. No, still minus 10. So let me push it higher a bit more, just so we have a bullish trade in front of us. So let's make it 385. And now we are dealing with an 11 delta, positive 11 delta strategy. That is bullish. Okay. and that would be a call ratio spread, okay, which is a strategy. Again, we are not talking about call ratio spreads, but just so it's clear for everyone, a call ratio spread. I just compressed that by mistake. A call ratio spread is a strategy where you buy a call and you sell 2 calls at a higher strike. Okay, so in this case, using the 358 and the 385, this happens to be a bullish trade, and I'm calling it bullish because the delta, the initial delta, is positive, 0.11. Okay, it's not like it's a great value of delta, but it's a positive delta, so it's bullish. So let's say you want to project this tool. So why would you even project it? Which is Jeff's question. What are we going to do with this tool here, and what are the benefits? So first of all, projecting. The concept of projecting means to take whatever characteristics this option strategy has and push it forward in time. Okay, so the key word here is time. We are used to, if you were not to be an options trader, we are used to deal with charts. And if you look at charts, you have the price axis that goes vertical, and you have the time axis that goes horizontal. Okay, so horizontal is the time axis, okay, and we are used to think of charts or markets as something that moves from left to right, being the left the past and being the right the future. Now, what happens is that in options trading, typically the majority of options platforms provide us with a risk graph, where the risk graph doesn't have a time component, right? You have the horizontal axis is strikes, is the underlying price, and the vertical axis is the P&L. Above the zero line you profit, below the zero line you lose, and we are fairly used. I mean, we are, I would say, very much used to see P&L graphs, and probably you are very comfortable with it. But the reality is that there is no time component. Okay, there is no time component because, again, it's all about P&L versus the price on the underlying. For sure, you can work on the time component by utilizing different expiration dates. So here we got, for example, 10/16, right? So maybe you can have 10/12, and now notice how I have 2 different dotted lines that represent the P&L, above or below the zero line, and on different dates. And certainly the risk graphs are very useful to project the P&L as the underlying moves, and you can play with the dates below. You can also play with the implied volatility, with the volatility adjustments, and as you vary those particular components, so you get to see how your strategy would behave, in this 2D, in this bidimensional type of graph, which is very useful. But at the same time, if you were to be new to options trading, probably that drives you crazy because, again, if you were to be new to options trading, you would be used to charts, and charts got the time component in the horizontal axis. So one functioning thought that we have discussed in the past is the fact that when you come to a risk graph, you can click on this show chart button, and this will move the risk graph to be vertical instead of horizontal, which, depending of if you are experienced trading options or not, you may appreciate very much this type of graph, or this drives you crazy even more. This, personally, if I was to share, it does drive me crazy very much because I learned to trade options many years ago. This type of charts did not exist. And when I started learning how to trade options, it was all about risk graphs. So because I'm so used to this horizontal view of the risk graph, if you make it vertical to me, which makes more sense, it drives me crazy. But even though it makes more sense, because vertically speaking, now you have the price of the underlying, it's still not that useful because you still don't have the price, you still don't have the time component. You have the time component on the chart on the right, but you do not have the time component on the risk graph unless you play with the sliders on the below part. And when you play with the sliders, you are playing with one date only. You are not playing with the overall life of the trade from now until the expiration date. So, long story short, Jeff, your answer is the projection tool is a tool that is going to answer that question. What's going to happen to my trade through time from now until the expiration date? if you were to project the trade characteristics, the trade behavior throughout time, like a chart looks like with a horizontal axis with time, well, that's exactly what the projection tool is going to do for us. So we have the ratio spread here on the top. And notice how we have the horizontal axis all the way, here on the bottom part of the screen. No matter what information we have on the screen, which basically is three areas, right? So we have the upper quadrant, which I need to discuss, the middle quadrant, which I need to discuss, and the bottom one, right? So it's three, if you wish, pieces of information, but those three pieces of information, which I'm about to describe, are all linked to the horizontal axis, which is time. So again, we call it projection because we are projecting in time from now, which is here. Okay, now is here, to the expiration date, which is here. We are projecting in time, this time here, what the trade behavior is going to be, depending on the various factors that impact the profitability or the lack of profitability of an option strategy, which is the underlying stock, okay, the underlying stock moving up or down, and the implied volatility of the options, okay, which the implied volatility, of course, will be impacted by the expectation for future movement, etc., etc. And of course, we also know there are other factors that impact the options prices, right? Which is, for example, the time decay. So guess what? This is going to be built in the projection because, again, one more time, this horizontal axis represents time, and therefore, the projection will take into consideration the time decay of those options. So again, let me rewind a bit and keep adding because there is more to discuss. But at the same time, I would like to rewind a little bit. We are going to be projecting the P&L. That's what I have on the top. Okay, so in other words, if you buy the call spread and the stock doesn't move, the stock, which is currently trading at 357, stays trading at 357. Guess what? You're going to lose $687, which is what you paid for the spread, 688. Okay, 687.5 to be precise, with the rounding of without the rounding of the decimal places. So if the stock didn't do anything, because this is a debit trade, on expiration you lost the debit paid. Okay, and this, you can see how the P&L would act this way, where basically nothing's happening. We know time decay accelerate as we are approaching the expiration date. So notice the angle of the drop is getting worse as time passes, and the moment you get to the expiration date, you lost the whole debit. So again, what are we graphing here? So what we are graphing is the P&L of the option strategy, like a risk graph, if you wish. But instead of plotting it for today or expiration date, we are plotting it through time, okay? Taking into consideration what the underlying stock is going to be doing, okay? And what the implied volatility of the options that make up for this specific strategy, in this case we picked a call ratio spread, is going to do. And now, how do you act on this? Well, guess what? Notice how in this particular case we have a horizontal line, blue color horizontal line, and here we have a horizontal line, blue color horizontal line. Well, guess what? I can move it. I can move myself into a specific date. So this is today, 10/14, and I know there are questions on the chat box. I'm coming to you guys. So 10/14 is today. Guess what? If I move my mouse to the next day, 10/15, okay? And by the way, this is going to be a weekend, so I would rather move to 10/17, which is going to be Monday. So let's say on Monday, I click and hold and I move this up, simulating the stock went up to 363.40. If I release my mouse now, this is going to show me what the P&L of the option strategy is going to be. And as you can see, there is some green color showing up here, right? I can be more precise if I turn on my data window. So if I put my mouse here now, notice how it says that the P&L of the trade is going to be $52.67. Okay. So now you can project on specific dates. What if on the next day, on 10/18, it keeps going higher? So the PNL will keep improving. What on the 19 it keeps going higher? The PNL keeps improving. What if on the next day, on the 20, it retraces a bit? What if on the next day there is a very nice, powerful move to the upside? Okay. Well, now notice what's happening, which could be counterintuitive for a trader, because you're thinking this is a bullish trade. Yeah, but it's a ratio spread. You are short 2 calls against the call you are long. So if the stock moves too fast in your favor, it's actually hurting the PNL. So you can actually understand these things through time. That's why I'm doing this initial exercise with a call ratio spread, because it would be difficult to understand this behavior of the trade on a risk graph. Unless you're an experienced options trader, it would be difficult to understand, where on the projection tool, this could be seen very visually. So let's say now on the next day, the stock was to drop. So we are back in business. Let's say the stock was to drop or rally a bit on the next day. So again, you can see how the PNL it's being calculated. Okay, but I'm gonna pause here. I have more to discuss. I have more to add as well, but I wanna make sure I'm not missing the questions on the chat box. Okay, so questions there. Joe, good to see you, my friend. How often do you use this tool? Normally, not too often, because I know my stuff. I don't mean to sound, don't get me wrong, please. I certainly do not mean to sound arrogant. But what I mean by I know my stuff is that I know what to expect from the strategies I implement on my trading accounts, because I've been using those strategies for a long time. I've backtested the strategies. I have rules around the strategies, so I know what to expect. So just by looking at a simple risk graph, I know enough to know if I want to check the trade or I don't, or I approve the trade or I don't. So I don't use it too often. But certainly, if I was to experience with a new strategy, or I was to experience with some sort of a complex tweak or something like that, I would certainly use this tool, because the way to assess what if scenarios on this tool is extremely powerful. Like, for example, let's say you're implementing a complex strategy to take advantage of earnings, and haven't worked on the implied volatility, which is the bottom part of the screen yet. Okay, but let's say you expect one of the legs of your strategy to have a great change of implied volatility, but the other leg you don't expect it to have a great change of implied volatility. So you can actually simulate different changes of volatility with different legs, and you can do things which are very complex, and certainly assess very powerfully, amazingly powerfully, and not sure if that's correct English, the outcome of a trade, the what if scenarios. So when dealing with very complex scenarios or new approaches to trading options, certainly I would use that nonstop. But when you are trading something that you already know very well, when you're trading something that you already surrounded this particular option strategy with very robust rules, after practicing a lot, after backtesting, then you probably know exactly what to expect, and therefore you may not even need to use this tool. You may not even need to use a risk graph, because you already know what to expect. But again, in other cases, this tool it's really very, very, very powerful. Okay, so coming back to the screen, great question, Joe. Coming back to the screen, again, what do we have on the top? We have the PNL, but also notice how I can, instead of the PNL, I could switch this to be the spread value, which would probably look very, very similar, because the spread and the PNL is going to be basically the same or about the same. I mean, the shape of the graph, the values certainly not, but the shape of the graph should be. But I can also simulate on the upper part of the graph the delta. So now notice how this trade, for example, talking about understanding the behavior of the trade, notice how this trade through time gains delta. Okay, it gains delta through time. So notice that earlier, if the stock moved too far too fast in our favor, actually we were being hurt. If that was to happen later in time, okay, if this was going to happen later in time, notice how, here I got 382. So if I make this to be 382 to make it more or less equal, let me make it equal to 382 something. Okay, so 382 on expiration versus 382 on October 24. So notice how the P&L is so much better. And why is that? Well, notice how the delta increases through time. And you would not know that. I mean, you would if you study the strategies in a different way. But I would say that it's very easy to make a mistake or an assumption that is not in line with the reality, where when you project your option strategies and now you look at your bricks separately through time, now you will know how this strategy, would benefit very much from having the stock move towards your target slowly instead of fast, because delta increases through time. And that's an important thing to know. Or, for example, what is the behavior of gamma through time? So notice how gamma diminishes through time. Okay, but also there may be a behavior that has to do with where is the underlying. So what if the underlying drop? What happened to gamma? Well, notice that if the underlying drops, actually gamma goes up. So if you were to use a hedging technique, like using stock against the ratio spread, and the market was to move against the trade, the positive gamma here, the increasing gamma through time, would help the hedge to actually create an extra profit for the trade. So again, understanding all of those behaviors, not only understanding, what's my gamma value, right? Which in this case, is 0.073. Okay, great, that's nice to know. But what's my gamma value through time? It's another, way to think of the behavior of the trade, the characteristics of the option strategy you're utilizing, which may allow you to have rules that are more intelligent on how to massage the trade through time. Okay. Can this be used with options replay? No, it could not. With options replay, it's just pure value of the options extracted from the options chain. There is nothing to project, because you could actually project the reality of the trade when you replay the trade. So there is nothing to project into the future. You can just replay it and you get the real outcome that took place in the real world on those past dates. This is more about pretending to do a replay, but doing a replay into the future, which makes no sense. That's why we use the word project, which is kind of like a replay into the future. Okay, if I could, mention it this way, which it would not make sense. Replay, future is a contradiction, but I guess you get my point. Okay, I'll take a sip of water if you don't mind. Very good. So we can simulate the P&L, the spread value, the delta, the gamma. You could also simulate the theta. Notice how as time passes, theta increases. This is the case of all options contracts, but not necessarily the behavior of an option strategy. Depending on how it's built, it may be the opposite. Actually, theta decreases through time. So again, all of those things are important to know when you are putting in place a new strategy. Okay, your Vega. Okay, so you can see how the Vega is behaving. Again, notice how when the stock went against you, Vega went up. If the stock was to go in your favor, the Vega kind of remains constant. Okay, so ratio spreads are actually a great strategy to use when the implied volatility in the market is more or less in a midpoint, and you don't know if volatility will tend to rise or drop. So ratio spreads or directional butterflies, which is very similar as a strategy, gives us this, Vega component, which is quite constant. Okay, it only changes really when we get very close to the end of the life of the trade, close to the expiration. Okay, but the remaining time, as you can see, is fairly flat for a long time. So again, understanding these characteristics of your strategies is important, and again, this projection component where you project through time, it's certainly very useful. The row, you can see as well here how the row component, unless there is a very violent move or change of direction on the trade, you can see is quite constant through time. Okay, and of course, if there is a change of price, of course your row also changes, right? But notice how in this case, I'm creating here a little bit of a smooth move to the upside. And notice how if the market behaves very smooth to the upside, notice how the row remains very constant, very stable. So again, you could basically, conclude that those call ratio spreads are ideal strategies for outlooks where you expect a market to move, in this case to the upside because it's bullish, positive delta, but you would expect that market to not to be volatile, to be a market that moves slowly to the upside. So applying these particular strategies to, let's say, an ETF like SPY probably makes a lot of sense. Applying this strategy to a very violent stock, such a biotech stock that may move up very fast, may not be the most efficient strategy in the world, given the fact that some of the Greeks would be impacted very much as the underlying itself is moving violently. Okay, so again, the benefit of projecting such values, not only the P&L, but being able to project the Greeks, it's really a powerful thing. Okay, but I'm not done yet. Okay, I'm not done yet. So what else can we do as well? Well, we can also work on the implied volatility. And now, of course, in this case, we're using two units, the 358 call and the 385 call. Those are two units. I mean, we got a total of 3 units in the trade. So actually, I should not have said we're using 2 units. I should have said we're using 2 legs. Because we have 2 legs, but one of the legs have double the amount of units than the other one. That's what is called a ratio spread. So now for each of the legs, you could treat the implied volatility separately. Okay, so notice if I put my mouse in here, okay, with leg number 1, we have a volatility blue color of 30.75, and leg number 2, okay, we have a volatility of 27.60. Okay, so this is the options that we sold, and the one we bought got a little bit of an extra implied volatility. So you can see there. And when it comes to simulating what's going to happen to your trade through time, notice that we have this horizontal line in the middle. This is the midpoint. So the way it comes by default, you could come now here and say, okay, what if volatility drops? What if volatility rallies on this particular date? And again, all of this is going to, of course, impact the P&L of the trade. This is going to impact the P&L of the trade, but not only the P&L, the change of volatility would also impact the delta, the gamma, the theta, the rho through time. And certainly when it comes to understanding your what if scenarios, so let's say, just thinking out loud here, so one of the strategies that we use often in the live sessions that we conduct is the double calendars, isn't it? So when using double calendars, okay, you have a high sensitivity to implied volatility. So maybe you want to understand what happens to your options contracts if implied volatility changes in your favor. What if implied volatility changes against you? This may give you ideas on how to maintain your trades, to have a more efficient trade management set of rules. And of course, this tool gives you this particular advantage where you can simulate through time certain Greeks or the P&L overall, as time passes, as the underlying moves, as implied volatility changes. Now, the way I have it set up, which is the way it comes by default, is that notice when I move the line, notice how it shows. Let me try to freeze my screen here. Not like that. Let me try to freeze the screen like this. Here we go. So notice that when I move the center line, notice how automatically the upper line and the bottom line, they move in tandem, they move together. So the thing is that at the beginning, the line I had in place for me to click and adjust up and down, it's, if you see, it's actually the midpoint between the implied volatility of both of my units. So in other words, this line is the average implied volatility of the strategy. If it was an iron condor, okay, let me do that. So let's say I have an iron condor, which is 4 units. Okay, short iron condor, for example, whatever came with, the strikes. So notice if I zoom in. Okay, now. So notice if I zoom in that I got 4 lines with 4 colors, the purple, the yellow, the blue, and the orange. Why 4 lines? Because I got 4 units. Each got a different level of implied volatility. Okay, as you can see, 30, 30, 30, and 30. In this case, it's very similar because there are strikes which are very near to each other. If I widen it, okay, so on the put side, let me go down by $10. So So I'll do 45 and 46, and on the upper part I'll go up by $10. I'll do 70 and 69. So if I go out, okay, you will now see greater is loading. So give it a second. So you will now see greater differentials where on one side we got 32s, on the other side we got 29s, and that's just because the strikes are further away, like what we had earlier on the ratio spreads where the strikes were further away, isn't it? So in this case, we can associate, but it's 4 units. Well, what's my point? Well, my point is that no matter if it's 2 units or 4 units, the line that we got ready there to click, it's always located in the midpoint of whatever the units provide. Okay, let me make this a bit more extreme. So you see 2. So from 369, I'm gonna go up to 74. From 46, I'm gonna go down to 40. There's no 41. I'll do 40. So I'll do 75. So $5 of strike price increments, and now notice how the implied volatility have even more difference between each of them. But again, my line here is still in the midpoint. So when I move that line, I am assuming every one of the strikes is going to move up and down, and they will all maintain the same proportion, which is, definitely a pretty good way to approach it. But it is not necessarily like that. For example, what I mentioned before, let's say, for example, earning plays or strategies where certain units are extremely far away from the current price and the stock moved a lot in a different direction, right? So what's going to happen with that, right? So then, when you do your simulations, you may have lack of precision by simulating your changes of implied volatility to be just the midpoint of whatever the original implied volatilities were. So what can you do? Well, you can click on the settings wheel here. Okay, and this again, we're getting like super crazy perfectionist here. So now you can come in here, okay, and you can actually edit each legs separately. Okay, you can show all the legs. Okay, and but here, when you show all the legs, you cannot edit separately. Okay, they still move in tandem. But if on top of that I click edit separately, and it's going to give me this error, which I need to restart. I need to reset and restart. So I click yes. Okay, so now it's being restarted. So notice now how I have 4 horizontal lines where now through time I can say, look, this call, okay, what if the implied volatility went down? Now for that one, okay, what if the implied volatility went down so much more? For that one, what if the implied volatility went higher a bit? For that one, let's say there was some sort of a price anomaly here or something, and the implied volatility dropped a lot. So again, now you have the whole precision through time per leg of changing the implied volatility values, okay, while the stock, price movement is also moving, and now you can again simulate your profit and loss or your deltas, your gammas, your vegas, all of the Greeks. So again, this is a tool that if you were to use it, and going back to you, Joe, if you were to use it every single time you trade, you would spend an hour every time you're planning on a trade. This is not a tool that is designed for you to use every single time you trade, but it is indeed very useful when it comes to implementing a methodology, especially if it's a new methodology, and you really need to understand your what-if scenarios. You can really work on everything, time passing, implied volatility changes per strike or overall, the movement of the underlying, and then looking into every one of the Greeks and see, what happens then. So again, very, very, very powerful in order to be able to implement that. You also have a few changes here for the stock, which allows you to graph it differently. Okay, nothing magic really, but you can graph it differently. You can have bars or lines or things like that. And when it comes to implied volatility, the other thing as well that you could do is to be like, look, because implied volatility has the tendency to go back to the mean, So, let's pretend my implied volatility is going to go back to, let's say, a 60-day historic volatility. So you can even go this route of, whatever implied volatility is now. So, let's use, instead of using implied volatility values, let's use historic volatility values, because, the assumption would be that, implied volatility would have the tendency to revert back to the mean. And now you can be doing that, which, may be also a good reference or way to go. Personally, I prefer to use implied volatility or go with each leg separately, maybe just because I'm a bit of a perfectionist. But again, in this context of understanding very well a new methodology you are implementing for your trading, really looking at each leg separately, I would say, is the best way to go, even though it would take a lot of time to go through all the what-if scenarios, but it will give you the answers you're looking for. Cool. Okay, so would like to take questions. If that's okay, I'll take another sip of water as well. How is it going? If you have questions, this is a great moment for you to type. If you don't have questions, please let me know. Give me a confirmation that all was well understood. So I know what you guys need. I'll take a sip of water as I wait for you guys. Looking at the chat box, so far no questions. I'll wait for a little more, because I know if there are no questions, I know I'll get your all good on the chat box. So just waiting for that. To be honest, this tool, while I'm waiting, guys, to be honest, this tool is crazy simple to use, but at the same time, it's not a tool for for basic applications of options trading. I mean, certainly I would even say for educational purposes. Let's say you're taking a course, the first time ever in your life that you're taking an options course, and someone is explaining to you how to trade a call, or what does a call does for you, and you add long call, and now you play with it, and the stock goes up, it makes you money. The stock goes down, it loses you money. If the stock didn't go your way and the option expired, so then you lost the whole thing. So I guess this is, for a basic trader, for a new trader, it's actually a fantastic tool to use. But what is fantastic for that very basic approach, or kind of educational approach of understanding options trading, I would say that, at least the way I think about it for myself, is that the real power and beauty of this tool really is for very advanced applications of options trading, like really, really advanced, when you are looking at what-if scenarios, when you have very complex strategies and you want to understand better, what if you do this, what if you do that, like, let's say maybe you have a position, the stock went against you, and you are considering, so what if I sell a call against my stock? What if I sell a call and then I buy 2 puts below? What if I do this? What if I do that? All of those applications, from a common sense point of view, you may be thinking, look, if I sell a call, I bring in premium, so this is what's going to happen, so let's do it because it makes sense. But then maybe you missed on, what if implied volatility changed? What if while time was passing, something happened on the stock price? And then later in time, you get in trouble with your trade, and it's because you didn't assess a specific what-if scenario. So again, using this tool for those particular applications, it's, I would say, perfect. It's ideal, okay? And, you spend an hour moving things up and down, and you do develop a great understanding of what is it that you got in your hands. That, to me, is the real power of this tool, and that's when I use it for myself, okay? Cool. Okay, so let's take a look at the chat box. Yes, Mark, you could spend a lot of time doing what ifs. Exactly. And again, this generates great level of maturity, isn't it? On understanding, what is it that you got in your hands when you trade, okay? And which developing this level of maturity also goes hand in hand with confidence, right? So now you understand your trade setup, you're confident, you trade with confidence, you don't miss trades. Again, it's a great benefit, okay? But this is something for you to take it easy and spend an hour or two, right? If you're gonna be running a new option strategy, you put it in here and you just assess. This happens, that happens. So that's great. Jeff, thank you for your confirmation there. Mark, how did I zoom in the Aaron Condor chart? I'm just using a software that I use for the online presentations, and this particular software allows me to zoom in and out. This is not something built in top or built in window. It's just a software I use for the online presentations, Mark. Okay. Yeah, if you wanna, in general, if you wanna see things bigger inside your top, so what you could do is right click and get your display settings on your Windows. Okay, so this is my display settings. As you can see, I use 3 monitors set up in a very particular position. And so what you could do is that you could come here and work on the scale. Okay, so sorry, I just went to where I didn't want to go. So you could work on the scale, right? So when you got 150, so you can make it 200, you can make it 100. So you can change the scale, and this will make everything bigger or smaller in your screen to a level that makes you comfortable. Okay, so I would suggest that this is probably the best way to adjust it. What I've done, has to do with, it's a presentation tool. It's not a tool in Windows. Okay. Let me see. Mark, do the lines on the right take options expiration into account? The lines on the right. I'm not sure what you mean, the lines on the right. So the end of the chart right here, at the end of the graph, this is 11/18, which is the expiration date of your option. Okay, so whatever expiration date you get, you will get a projected graph on the right that ends when the options expire. Okay, so because obviously there is nothing else to project after the expiration date. So when it ends, that's the expiration date. So if I misunderstood your question, please clarify it for me, Mark, because I was not very clear on what you meant by that. But hopefully this is what you meant. Also, what are the 2 yellow lines in the projected? Oh yes, got you. Let me get a new one, and I will talk about the yellow lines. So let's project. Okay, let's project, and let me get. I got a basic strategy here, just a long call, and I didn't touch on anything. Okay, and so you are referring to this yellow line here, right? That's what you're referring to, isn't it? So this is, I believe that's what it is, right? So these are the projected profit and loss values of the strategy. Okay, so you can see here yellow color projected values. So in other words, each option strategy has probabilities built in, right? So if you look at the option chain, so you have break-even probability, in the money probability. If you look at the risk graph and you load a long call, as we discussed in the past, we have a tool here called the ideal strike zone. I'm sure you remember, and based on the Chebyshev theorem, so end up plotting that zone there, which has a lot to do with the probability of the options to have at least some intrinsic value on the expiration date based on the Chebyshev model, right? So if all of those built-in probabilities on the options models were to become a reality, so you would see the speed of growth of the P&L to be like that. Notice that if instead of directional strategy, I use let's say an iron condor, which is non-directional. So notice how the lines, instead of one line, is 2, one above, one below. Okay, and yeah, so this is a projection through time of what of course, and this changes if the stock changes, right? So if the stock moves here, right? The stock move there. Wait a moment. This. Yes. So the problem with that strategy is that the strikes are too close. So let me drop this by 10, for example. So if I do 10, if I do 4, if I do 4, and I do 10, something like that. So if I do something like this, okay, and I got this particular range here. So notice that the moment I move these things, okay, so that particular I'm not sure why the yellow lines are not being recalculated now. I guess it's because I had already something loaded. Let me load it from zero. Sorry about that, guys. But basically, this is kind of like a running simulation that is telling you, based on the probabilities built in the options model, where the shape of your profitability is likely going to look like. Okay. In case the stock goes up, or in case the stock goes down if it's non-directional, or in case the stock goes up if it's directional bullish, in case the stock goes down if it's directional bearish. To be honest, it's not a very useful line. It's probably the least useful line of all the lines we got here, but that's what it means. So I'm just gonna redo this. Give me a moment. Okay, here we go. Okay, so you have this Aron condor, and again, based on the probabilities built in the model, so you have odds for the profitability to be in those areas. Okay, so if the stock was to be here on expiration, okay, you would have a negative P&L, but there is a decent level of odds for this to happen, and this has a lot to do with the fact that the options that we're using are fairly close, and therefore the probability of being in the money is very high. So that's why. So again, this is kind of like projecting the pricing model through times in a daily basis, if you wish, where everything is being recalculated. Of course, assuming implied volatility stay constant unless you change it. Okay, and as you can see, the yellow line is being recalculated. Okay, and the shape changes slightly. Again, it's I would say a smart calculation, but from a mathematical point of view, but a pretty useless graph, in the sense that the markets are way more random than that, and if they were to move because of something, they move because of on-field orders more than probabilities. So you may have multiple UFOs below price, and therefore probabilities to go down mean nothing versus probabilities going up. Now, these yellow lines will be calculated like there are no UFOs, okay, because it's just like raw probability. So again, very, very smart mathematical calculation, but quite useless. Just cute to see on the screen, but not too much more than that. Okay. Cool. Okay, so let me see more questions. Cool. Joe, would you use this tool to determine if you need to add positive or negative theta or delta? I am assuming when you say if you need to, you are talking about trade management. Okay, I am assuming that. Could you please confirm if that's the case, Joe? Okay, on Mark, I understand the display. Sir, sorry, I meant the earnings date. Well, this is SPY, so there is no earnings. So when you change to, let's say, McDonald's, okay, so if you look at McDonald's on a chart, MCD, okay, so the earnings date for McDonald's is October 27, okay, which October 27 is somewhere here, October 27. So this is the expected earnings date for McDonald's, but notice that there is no indication here. Okay, there is no indication. So for you to be able to see the earnings date here, really, you need to take a look on the chart using the earnings study, so you know when that is. Good news, and by the way, I didn't mention that, is that you could actually draw here. So you could come into August 27, and draw yourself a line. Sorry, I just made it horizontal. Okay, let's make it vertical. So you can make it vertical here on October 27, and this purple line means something. You can also write. So you can come in here. It's like, hey, earnings here, right? So you could do those things because really this is like a chart. So you can actually write, do drawings, etc., etc. And by the way, if you save this inside your top page, obviously all of these details will be saved as well. Okay. Cool. Your first question. Do the line on the right take the... No, they don't. Okay, so then the answer was no, Mark. Got it. Okay, and Joe, you said yes to trade management. Okay, yes. So again, let's say you have a trade on McDonald's. Okay, and again, the answer to your question, Joe, depends. Okay, and let me explain what I mean by it depends. So let's say, for example, you have a bull call spread on McDonald's that you entered some time ago. Okay, so let's say McDonald's was trading much lower. So when you did this bull call spread, instead of being filled at 5:30, let's say you got filled at, I don't know, 3:12. Okay, it was a long time ago, and therefore today you are in a profit. Okay, and now your question is, so for example, you're like, okay, so I don't want to give up too much profit. So if the stock drops to, let's say, 240, okay, on the 17, okay, if the stock drops to 240 on the 17, which is right here, okay. So the question is, let's say I want to do some trade management action on that day. For example, I want to short stock against the stock to hedge myself. Now, would it make sense to do this? Yes or no? Well, the answer depends if you got positive gamma on the date, which on the date, if you put your mouse in here, your gamma would actually be 0. So you will not benefit from a hedge, okay? But just for this conversation, let's pretend your gamma is positive. So the next question would be, okay, so how many shares I'm going to use to hedge? And then you would look at your delta. Your delta would be 19. So you would then short 19 shares. Sorry, I got the mouse in the wrong location right here. Your delta, okay, it was in the right location. Your delta is 19. So you would just go with 19 shares short to hedge. So now, your question may be, no, but wait a moment, I just look at these once a week. So what if I reach 240, on the next week, on, whatever, 10, 20, something. So you would adjust this to be 240 on that particular date. And, on that date, your delta is 22 instead of 19. So then you would want to hedge using 22 shares against your bull call spread. And then you will be hedged, and with a positive gamma, no matter if the stock goes up or down, you will make a little bit of an extra profit. So if you are thinking of using this tool for this type of predictions, right, your what if scenarios for trade management, such as, okay, so if the stock gets there on that date and implied volatility has moved by a little bit, because when the stock goes down, typically volatility rallies a bit. So what if, on that date, volatility went from an average of 28 to 29.5. So what would be my delta? It would be 22, right? So I'm going to use 22 shares. So if your question is this, Joe, can you use this tool for trade management this way, doing predictions of what may happen, and therefore just put an order in the system with those particular values? I would say that makes a lot of sense, and this is probably the most efficient way to do it. But for other strategies, probably the way we do really on the live sessions when we are trading together on the coaching sessions, right? So typically, I would say probably the compare feature, or when you compare spreads on the risk graph and you copy primary and you change things here and you understand what to do and then you implement what to do today, right? So this tool probably is more useful for trade management, even though if instead of today you plan to do something in a future date, so then this is the tool for you to use, even though you don't have a compare feature, so you will need to work on editing the spread and making more changes here to understand your what ifs. Okay, so yeah, long answer to your question, Joe. Very good question as always. Thank you for that. Jeff, can you set alerts? No, The answer is short. No, we don't have alerts on top. This is a functionality that hopefully one day will launch. At the moment, we don't have alerts across the board, and therefore there are not alerts for this. Mark, I got you ready. Okay, so look, perfect. We just reached the top of the hour, so the session is over. Actually, it seems that we just used the time very, very wisely today. Such a perfect way to use the time. My friends, I'm about to say goodbye, but before I say goodbye, again, one last confirmation from you guys. How was it? Any question? All good? If all is good, you can just type bye, and I will know all is good, and you're just saying bye. If you have another question, of course, as always, I don't mind to stay a little longer, and you could certainly ask. Let me know. In the meantime, I'll as always take a sip of water. This tool, to be honest, it's amazing. Okay, it's actually in the process of being patented, so it's a very powerful tool. So hopefully you have enjoyed it. Thank you, guys. I see all your thanks and buys and so on. So that's very appreciated, my friends. Always a pleasure. Looking forward to seeing you next Thursday in the live session. Again, I missed the prior week, so I'm looking forward to catching up with time and spending time with you guys. See you soon. See you there. See you then. Keep up the good work. Bye-bye, my friends. See you soon. Bye-bye.